Welcome to TradeTheNBI.com. This is John. This report is for the 7th. Well, things proceeding pretty much what the readings gave us. We had this breakdown that started right up here at the peak, and even earlier we had our warning signs. We were expecting a move that would take us to the supports, and then once we saw the DOC spread, we expected that to break and move towards the bottom range, which is why I added those lines, because it was sort of expected. And sure enough, the market did exactly what we were looking for. Now, there's still that lower 44.66 potential for the fill of the positive extremes that go back to, well, a little after July. Right there was about the 12th when the breakout first took place. So that's the bottom side of it. We were at a minimum looking for the secondary candle right there to fill, and it did. What we're seeing though is DOC short-term buyers popping up, and potential short-term buyers could take out the falling DOC orange. In this particular case, coming off the spike, what we would need to see is a pivot back upward of the orange to get any further decay back towards the fill of the positive extreme. Without that, you're more likely to see shorts have enough juice to at least hold things into a moderate zone. We can already see a flattening of DOC green midterm buyers as well as the long-term buyers. Short setup within this is still fairly decent. So it's going to take quite a bit of transition. And I mean, this is post a period of new fund money. So there's plenty of sideline cash available to pounce on this. But we've saw a lot of that move towards treasuries in a little bit too much of a dramatic fashion. But these kinds of excesses always take place. Now, the NQ has been a little bit different. This one was not the positive extreme. It was beginning right here and has already filled back in place, still in a much weaker position comparative to the S&P from an NBI reading, with the white NBI still leading. But you already have the crossover of steel over orange here. Now, as long as the orange stays between the cyan and the red, there's something to note. You're going to get a continuation of whatever has been the direction in this particular case right now, sort of modest down sideways, and that will persist until there's a change in the orange reading, whether it dips below the red line or we get a new crossover of the green back above red, and that would be the buy cross that would transition that, and then you would expect to see a fading of shorts at that point back below the zero line. So those are the things to look for. But at this particular stage, softer bias is still built into it, even though we're going to have that short-term buyers potentially give things a pop. So it's just going to be an opportunity for shorts to attack a little bit higher price. So we talked about this move was a bit ridiculous from Treasury, so it was not a surprise to see that get bid up, because that was a little too far, and I said as much. That was a bit of an extreme, and so money flying back into there to soften that yield just a little bit, but still more in the range, because it should have been sub 100 for, well, geez, about 6 months now. But okay, sometimes you got to wait for it. This is the problem. And oil, in this continued exaggerated state, it's going to cause a ripple effect all through it, particularly in Europe. Is going to be hardest hit within this construct. And what we're seeing is mostly it's a relative supply issue from the Western U.S. side of the situation, reduction in production. And that is definitely going to create both pressures to the upside. So all the people worrying that, the Fed was going to flip, you're not going to see a flip with the oil at these levels. It just isn't going to happen. So the Fed is going to stay the course, and you can probably look for another round of opportunistic businesses who have some flexibility to go ahead and continue either their product shrinkage and or price increases, and these will be the justifications for it. So worth noting is just where things are at. The euro created that bizarre pop the other day, and of course filling back, and this is what they're going to be continuing to do. Anytime they think they can get an advantage and push against the trend of things, they're going to try it simply to create as much short covering and see if they can create another one of these false short cover rallies. But at the end of the day, Euro's in a disaster zone. We are seeing a dip of the orange below the red line and significant fade off of shorts from the previous day. So where this meeting takes place, if there's a rejection to the upside, or if we get the green cross, that will determine whether or not this trend south continues, or if it's enough to push things back up. And we look at that extreme, and we're still dipped below the red line. So I don't think it bodes well, but that would not be the first time to see central bank intervention to prop these things up from a gold standpoint as well. Bizarre that it's being kept at this level, but again, we've talked about this before. When we're talking about paper certificates versus the real thing, it's a lot easier to keep a stranglehold on that. But as oil goes, there's no question that gold is going to have to go with it. Now, that doesn't even take into account the geopolitical situation we've seen. These latest attacks of Ukraine into Moscow, into private buildings. The other day there was use of cluster bombs, so the retaliation aspect of things starting to grow, and then there's a question of whether or not the Ukrainians are using planes that they're parking in Poland. And if that's the case, that could escalate things rather quickly. We also saw the huge deployment of Wagner forces on the western flank, right at the border of Poland. So that didn't even take into account, the blockade in the Black Sea and U.S. flying their drones near proximity. So there's a lot of potential downside risks that as things escalate, you're going to see the market react to, and potentially very violently. So keep that in mind, and that's where resources like gold and that will take a sudden boost when that kind of situation takes place. The dead zone at this particular point has been Bitcoin and the others after the BlackRock rally, is what I like to call it, because that's kind of what it was. No real new interest because nothing else is happening. That's a strong spike at the 50% range. Would have needed to have seen a stronger DOC spread, a really significant spike up of shorts to see that break. It's potential that we could get slightly below that 50%. If it's a strong break below it, though, we have all the way back to this positive extreme at 26.9 that would have to be filled. And that would be a complete fill of the most of the breakout that took place. So interesting to see that take the readings from that standpoint. You're not seeing it from a ETH standpoint, so that's a little bit interesting. I think we're likely to hold right into this range, if not just a slight dip below from ETH's range. The positive extreme was right about there in the 1775 range, so not too far off where price is at. So that could be a bit softer than the exuberance that existed within Bitcoin. From a 50K standpoint, you can see that nice couple of day decline, push back up to the pretty much the previous 0% line, which is where it capped out, and then white spike turnaround, and now we're in a little bit of a buy configuration with the DOC as well, and we're meeting right there. So this will become a critical one, whether we get a crossover or if there's a rejection here. If I see the rejection, I'm expecting that 0% line probably pretty strong. If the green crosses over, I'm going to look then for the first spider. Short-term buyers have really pushed this up dramatically. It's been a nice turnaround here from a shakeout standpoint, and you can see we had this strong dip below the red line and now the pop back up, but that just means we're going to get a test back to it. So it's just a question of how long it will take before we return back to fill that zero line. Current action, you can see positive build from the weekend action, had been fairly strong, and then we just sold off recently in the last hour plus, and now holding on just fine. If we go back to Friday's action, we can see the cliff that really permeated things. So the pre-market was already soft. We had a nice bounce going into just before the bell, and that led to a strong buy throughout. And then once the trigger took place, white MBI crossing above the yellow, moving above that 10 level, all corresponding to the same spot. Just right after DOC spread, the DOC spread took place 1 bar before that, and boom, that just cascade fall apart. So that was kind of beautiful, very clean, and all generally nice action. That is the long and the short of it for now. I think that there's going to be some nice potential volatility because there's just a lot of things happening that can really throw things into a wild situation. So I would be good with my stops, but not within the volatility range that we're seeing because they are going to hunt them. Just be aware of that. And as always, though, look for me on the Skype chat. Trade well. We'll talk to you later.